How are we doing, everyone? Today I'm going to be showing you what we should be looking for and identifying when looking for potential trading setups when trading from either key level support, key level resistance or supply and demand levels. Welcome back, everyone. If you're new to the channel, welcome. Like I said, I'm going to be showing you guys what we should be looking for in terms of price action and structure when trading from key levels. So looking for confirmation to basically be taking our trades. So of course, trading from key levels and trading from supply and demand is a great way to look for high probability trades, and I just want to show you guys what we should be looking for when actually taking these trades. And what we shouldn't be doing is randomly buying at support because it's been a support and randomly selling at resistance because it's a resistance, or buying at demand or selling at supply, or just key levels in general. Okay, so let's take a look at this pair. We're looking at pound US dollar, which is my absolute favorite pair. If you guys follow me over my Instagram, Forex_Loz, you'll know this is one of the only pairs I trade. So what we're looking at here, okay, is we can see that price is at a 1 hour demand level. If you guys want to see how I've identified this, this was a recent supply level. Supply then became demand. Okay, so we're looking at my lower time frames, right? But this applies for every single time frame. Okay, we're just looking at how we can look for potential trading setups at a key level. Okay, so this doesn't matter if this could be the 15 minutes, this could be the hour. What we're doing is we're identifying structure and identifying price action at key levels. Okay, so usually we want to identify our key levels on a higher time frame, but if you guys want to know how to identify that and look for them, I've got plenty of other videos telling you how to do that. So what we're doing is, like I said, is we do not want to just randomly buy once price gets to a support or gets to a demand or gets to a key level. Okay, so these principles and these concepts I'm going to be showing you applies for whether you are looking for sales at a key level, resistance or supply. We're just looking at the buy setups for now, okay, but like I said, this applies for when looking for sales at key levels, right? But what we can identify is we can see that price is pushing bearish into this key level demand. Okay, it's price is pushing bearish into demand. So what we're not going to do, and what a lot of traders do, is they just, because they've got this key level support or key level demand marked out, as soon as they see price come to the level, what they do is they instantly buy. Okay, they either get faked out, or price knocks them out, or price just doesn't give them an opportunity to take the trade, or they take the trade because they simply see price at these levels, and that's the worst thing you can do. What you want to do is use price action and structure to make sure that the sentiment is in your favor to have a higher probability of taking profit. And that's what trading is about, guys. It's about having and increasing our probabilities when taking trades. Okay, so enough of the talking, let's actually take a look at what we're doing. Taking a look at the price action. Okay, we see price pushing bearish into this demand level, but right now price is bearish. We need to be looking for the sentiment change. Okay, we need to be looking for price action to display bullish structure, right? So a couple confluences we can look for is, one, we can see strong impulsive candles from this demand or from this key level, or from the key level you're going to be trading from. Identify impulsive candles to indicate to us that the sentiment is there of the direction we want to be trading, right? But we don't just want to be buying or selling once we see the impulse. We want to be identifying structure, and the best places to be entering in trades is to be entering at the end of the exhaust. Okay, so when we're looking for sells at supply or at key level resistance, we want to be entering at the lower highs, and when looking at buys, we want to be entering at the higher lows. Okay, so the first thing we want to be identifying is we can see the sentiment. We can see the sentiment changing. We're seeing that buys are now stepping in, but this is not enough. We need to then see price pulling back. Okay, we can then see price has now made what we call a higher low, but price hasn't broken any recent bearish structure that we've had here. Okay, so this is still not enough confluence for me. Okay, we want to be seeing and making sure that price is taking out any sellers that we've had in the market. So what we can do is we can just wait. It's about being patient and letting the structure play out and letting price action basically tell you who is in control. Okay, so this is perfect. We see a strong impulsive move. This is now telling us, okay, it's confirming that the buyers are now taking control of the market. The structure, the price action is telling us that the sentiment is changing and that the buyers are taking control, and that we are actually in fact taking out any sellers that we've had previously in the market. Okay, so the best places, a little tip for you guys, the best places, like I said, we need to be buying and selling from. When looking for buys, we need to be making sure that we are buying at the higher low. This will just increase probabilities when taking trades and most likely reduce drawdown when taking our trades. It's basically putting yourself in the best position to increase probabilities and to increase your chances of actually taking profit. Okay, so don't buy when you're in a push phase, guys. Don't buy when price is pushing up, or don't sell when price is pushing down. Wait for that pullback, wait for that exhaustion phase to play out, and then look for the entry, okay? So the confluences here are at a key level demand. We had price pushing bearish. We then are now seeing this sentiment changing through price action and structure. We can see that we've now made a new higher low. We're seeing price push up, breaking recent key levels we've got here, wiping out any sellers that we may have. And then what we want to see is price pulling back and creating them higher lows. And a little tip for you guys is the way to identify these higher lows is just look for them wick rejections. Look for where price is pulling back and then creating wick rejections. What we can do is we can either enter once we see our first wick rejections, or for a less aggressive entry is we can enter once we see price starting to push in our direction, okay? So for some of you guys that understand candle patterns or know them, this is obviously a bullish engulfing candle. It's engulfing any previous bearish candles we've got, indicating a strong bullish sentiment. So obviously this is how we're going to be doing it when looking for buys at a key level support or demand, but these concepts apply for the exact same for supply. So just flip it around, okay? We see price pushing bullish into a key level. We need to then see the bullish sentiment depreciating. We need to see price failing to make them new higher lows and higher highs. And then we need to see we need to then see price making new lower lows, making new lower highs, which will then indicate to us that the price is turning inside out, creating bearish sentiment. And then we can look for the sells at the lower highs and potentially have price then fall from the key level resistance or supply that we are trading from. So like I said, these concepts that I'm showing you here is the exact same. Just be looking for price action changing. So we can see that price is turning inside out. Okay, this is what we like to call it, price turning inside out, right? We've gone from sells, we've then turned inside out. So we can see it here, price is pushing up. We've made the new higher low, we've got a higher high, higher low, and we've then got a strong bullish engulfer, which could then now be our entry signal. We're trading at a 1 hour demand, but we're not just buying as soon as price gets to here. We're waiting for price action to indicate to us that the buyers are actually taking control of the market and that the sentiment is changing. So what we can do is we can simply take the trade, okay? Remember, not every trade we take is going to take profit. It's about probabilities and running out the numbers, okay? But by using this and understanding these concepts, you're going to increase your probabilities, okay? You're going to more likely have higher probabilities trades because you're not just randomly buying and selling at key levels. You're actually waiting for price to unravel, turn inside out, show us the actual sentiment of the market, and then you're executing your trades. You're not just buying randomly at demand and support key levels, or you're not just selling randomly at supply and key level resistance.
So on today's session, we're going to be talking about how to really identify key levels in the market where you can buy and sell with confidence. Because far too often, what traders are doing is they're drawing way too much information on their charts, and then this becomes very confusing and messy. Now, the majority of us, when we started learning trading, we learned to draw our support and resistance levels from our higher time frames, looking for areas on the market where prices reacted to before. Now, I'm not saying what I'm doing right now is 100% perfect, but what I do know is that this is an illustration of how traders draw their support and resistance levels. And what can end up happening is by the time you get these levels in from your higher time frames and you scale down to your lower time frames to look for your patterns and your entries, it becomes far too confusing. So on today's session, we're going to iron this out. We're going to identify key levels in the market where price has reacted to and shown an aggressive move from that level, so that you can identify tradable opportunities by the time you get down to your lower time frames. So without further ado, let's take a look at this first example on CAD JPY. Now, when we're looking at this, what I want you to understand is we're not going to be gathering any evidence from the left. We're going to just be simply identifying an area in the market where price has come to, has shown you no signs of why it has rallied from that area, and then identify what happens when price comes back to it. Now, it sounds simple, but there are a few factors that we have to consider before we do this. So if we look at this example, we can see here in and around this area, price has come to and immediately has rallied to the downside. Now, there's no supporting evidence to the left to help us to identify why this has happened. But what this could mean is that this is an area where sellers are sitting. So what we can do with this information is we can take a simple line from where this reaction has happened to in the past, and we can drag it to the right. Now, we never know when price is going to come back to this level, but what we do know is that there is a high chance in the future that if price gets back to this level, there may be a reaction. Now, is this enough to support why we should be selling? Absolutely not. But what we can now start to do is delve deeper into the behavior of how prices come back to this level. So if we analyze this market structure off the bat, what we can see is over the past couple of weeks, price action was pushing to the upside. Price was making higher lows, higher highs, and higher lows. Now, this is indicating a strong bullish sentiment in the market. Off of the back of those higher lows and higher highs, we had a very strong bullish candle to the upside. Now, we don't know that the market's going to reverse, and we don't know if the market's going to turn around. But what we can now start to gather is evidence and confirmation to identify what is happening at that level. So based on the information that we have here, which is bullish structure technically, with the higher highs and higher lows, we now have a strong bullish candle into this previous structure, and then immediately look what we have. We have a depletion of that bullish pressure in the market at this significant level where prices rallied from before. So how do we work with this data? Well, firstly, we identify where that rally happened before in the past, which is this information. We see how price is coming back to this level in terms of the structure, which is a bullish structure, bullish behavior, and then we start to identify how price is reacting at that level, which is a depletion in that bullish pressure, which is evident of 2 daily candles showing evidence that it's failing to break above this structure. Now, what we can now start to do is work out when the momentum shift happens. And how do we do that? Well, we can just simply wait for a strong bearish candle to push to the downside. This is now giving us evidence that the sells that were sitting in this area in the past have identified that they have stepped back into the markets, and they're showing true confirmation of this with this bearish candle. So how do we trade this? Well, you simply scale down using your strategy or the patterns that you trade to your lower time frames, and now you can start looking for tradable opportunities. They could be simple double tops on the lower time frames. They could be simple lower highs on the lower time frames. They could be head and shoulder patterns. They can be your breakouts. They can be your channel breakouts. They can be whatever it is you trade. And what you need to understand is that once you've gathered this information, which is very, very important, you can now start to take advantage of the behavior that happens after. You have 1, 2, 3, 4, 5, 6 days that we can see on the screen right now worth of bearish sentiment in the market, and all these daily candles will give you an opportunity to sell as long as you can use the correlation from the high time frame back down to your lower time frames, looking for those patterns and those processes. Now, let's take another example right here so that we know that what we're talking about is true. We have a level in the market here where price has come to in the past, not using any data right here to the left, and we can see that off of the back of this strong bearish pressured market, we had a very strong rally to the upside. So we can take that information, but remember, we're not just impulsively jumping into the markets, and we can draw our level like this. Now notice the difference here with this scenario. We do have that strong bearish candle back into a level in the market where a rally has happened before. But look at the example that we had above. The difference here is we do not have evidence of depletion in this market. As you can clearly see here, we have the depletion, but here we do not have the depletion, which clearly indicates to us that no matter what happens, we are not looking for buys unless we get that behavioral pattern, which is this depletion. So a very simple example, very powerful example, and this can be adapted to any strategy you trade, regardless whether you're a support and resistance trader, a supply demand trader, whether you trade structure based on lower highs, higher lows, Fibonacci's. I really don't care what it is you trade. It can be traded across the board. So let's take a look at another example right here. So here we have an example on Aussie dollar JPY. Now let's take a look at this process again. We're looking for an area in the market where prices come to with no data to the left to indicate why price would then rally from this level. And what we're going to do is identify how much this market has rallied off of the back of a strong uptrend. So this becomes a significant area in the market. Once we gather this information, we can then join the dots from right to the left, and we can start to see how price reacts around this level when it comes back to it. Now, again, we never know when it's going to come back to it, but that's what our plan will be. Now, a lot of traders will see this and say to themselves, well, this is very strong bullish market structure. And now look, I'm starting to see in and around this level, the bears stepping into the markets. And because of fear of missing out, what they will eventually do is they'll take this data and they'll draw levels like this and start to say to themselves, well, now this is starting to look like price is failing to push up. This looks like a potential lower high. And this looks like an area where price may react to and continue to rally off of the back of past history, which is this information here. But what you must understand is that we're not looking to jump into the markets because we think that there's going to be reaction. We need to wait for price to come back to that level to give us that reaction so that we can avoid being the traders that jump into the markets and get stopped out and then see the market come back to our level and rally. So let's gather this information. We see a level in the market where prices come to with no data to the left to indicate why there was a rally. This is indicating sellers must be in the market in and around this area, and we've identified this. Now what we can do is we can wait patiently for the market to come back to this level. Now this scenario is slightly different because we don't have strong bullish pressure coming back into this structure, but what we do have is a significant reaction from this level where we can see on this day the bulls were pushing really strong into this level off of the back of this uptrend, and we had a strong reaction. Now does this mean that we're going to sell the market straight away? Well, absolutely not. Because if we decide to take this trade based on a pin bar, technically what that means for us is we're going to have our entry below this level here and our stop loss above this level here. And then what that means for us is the range of our potential target becomes increasingly big. Now, granted, this would have hit take profit because we can see the data to the right, but what we want to do is minimize that. So how do we do this? We're going to wait for a significant reaction, which is this evidence here, off of the back of a level in the market where prices rallied before, and we're going to wait for the momentum shift. Once we have this momentum shift, then what we can start to do is work off of this data using the correlation with our lower time frames to look for tradable opportunities. And as you can see here, we have 1, 2, 3, 4, 5, 6 days worth of information that we can take to our lower time frames and look for those patterns we mentioned in the beginning. So please be mindful, and this is very important, that you wait for price to come back to a key level where price has significantly shown a reaction to in the past, but with no data to the left so that we can identify where the sell orders may be. Then we wait for the momentum shift in the market so that we can identify that the bears have actually taken over, and then we can take advantage of the days where this trend will continue to go down. And this is very important. It's pretty simple and it's very, very effective. And if you learn to do this in your trading, you will find that you'll be able to keep it super, super simple, yet very, very effective and powerful. And you will start to see the changes in your results going from losses and break-even trades to more consistent profits and consistency in your ability to trade. So I hope you enjoyed that lesson. Very short, very simple, but to the point. And that's how I like to keep it. And I advise you guys to give it a go. Leave a comment in the comments. Let me know how it goes for you. And as always say, if you enjoy this video, please drop us a like, subscribe, and until next time, take care for now.